Okay, it's time for an up-close and personal point of view on the stock market from a legendary fund manager in Anton Tagliaferro from Investors Mutual. He joins me at the desk to tell us how he's playing the market and what stocks he might like right now. How are you, mate?
Well, thanks, Pete.
Just had a wonderful holiday in Malta, eh?
I have.
Lucky so-and-so. Was the weather good?
Excellent.
Okay. So when you're there laying on the beach, were you thinking about the market at home and what companies look, well positioned for your strong investment?
It's too cold to lie on the market. Swim at the moment, but I normally get up about 4 o'clock over there, which is about midday here, to keep an eye on everything. So yeah, look, the market's had a very strong run in the last few weeks. Yeah. Yeah, it's getting quite difficult to find value. Of course, the Reserve Bank cutting rates has had a big influence. There's more, I think it surprised a few people. The expectation of another rate cut, that's all. 10-year bonds at an all-time low of 2.2%, so that's all, of course, influencing the market.
Okay, so if you're looking, rather than looking at specific funds, stocks at this point in time, let's just get your feel. The markets went down unbelievably low in January and February, and I was saying at the time, I thought it was an excessive sell-off. Now we've rebounded. Do you think the rebound is a little bit excessive, or it's taken us up to fair value?
I think it's taken us up to fair value. I think when you look at the outlook, not that much has changed. No. When you look around the issues around the world, Greece, there's still the potential for them to default again in July.
Picking on the Greeks and the Italians.
It's going to be headlines in July again. China, there's signs again that it may be slowing. So
Brexit, you worried about Brexit?
Brexit, not so much. I don't think that'll be a major issue. I think they'll vote in favour of staying anyway. But I think even should they leave, I don't think it'll make a huge difference.
Okay. All right. So you're talking fair value. I was speaking earlier with Mike Kendall, and the US data's made me happy than I would have thought, say, in January, February. There was a lot of negative stuff around the US. You look at the US data, has it been a little bit better than you expected?
Yeah, look, I mean, the US is in that recovery mode. It's a slow recovery. There's no inflation. It's not a bad scenario. Again, not strong enough where they have to put up interest rates and not low enough where anyone's got to panic, I think. Yeah. So it's quite...
It doesn't need negative interest rates.
No, it doesn't.
Which is good to know, isn't it?
Yes, one of the few economies in the world.
And what about the Japanese? I don't know if you picked up on it, but they've come up with a better than expected growth number. And the question is, well, is negative interest rates working in Japan?
Look, Peter, at some point, low interest rates do have an impact. The question is it going to be sustainable growth that's created? And the other question is, eventually, when those rates are reversed, what's the impact going to be? And that's the concern, I suppose, at some point, beyond the current scenario where rates are 0 to negative.
Okay, well, when I looked at where the market is, and you made the point, fair value, and I've mentioned on the program here a couple of times, that it kind of makes sense that some people who are traders, fund managers who want to make money, will be looking at where the market is now and say, well, BHP, I bought at 15 courageously. It's now around 19, or they might have even sold out at 20. It's not a bad time to take profit. Is that part of your thinking at the moment?
Yeah, if you've bought low, yes, it's not a bad time to take profits. I guess from a long-term point of view, BHP, again, you've got to look at where the iron ore price is, where it's going. It's probably not the best time to be buying, I would have thought, So I'd definitely be trimming some of those things, yes, and we have been.
But given the fact we saw it get down to about 14, 20, do you think that was like an typical example where a market was excessively negative on BHP and probably a fair value price is around 15 or 16, then when it got to 2022, there was a rebound on the other side?
Look, with hindsight, I suppose, yes, Pete, but the reality is BHP's cut its dividend yield is negligible and will be for a couple of years. Its profits are going to struggle given where commodity prices are. So, look, the share price will bounce around, but the reality is the profits and dividends will not recover for a few years yet.
Did you have exposure to BHP?
We've got some exposure, yes.
Were you annoyed when they basically said they wouldn't cut the dividend and then they did? What was your view as a old stager in the industry?
We were actually encouraging them to cut their dividend because it's ridiculous for a stock with such cyclical earnings to stick to this, dividend policy.
So it's kind of silly for them to make that commitment, wasn't it?
It was a bit hindsight again, yes, extremely silly. But I guess nobody imagined the oil price would get to $40 a barrel.
No.
Nobody imagined the iron ore price would be around $40 a tonne. So, you know, with hindsight, yes. But I suppose it just shows, you know, that even companies don't know where commodity prices are going.
No, without
And that's why we're always so cautious on resource stocks, and why we prefer industrials.
Yeah, now on that point, you know, you and I probably 6 months ago we talked about Woolworths and, you know, how was it going to make the change? They hadn't appointed the CEO. I think Gordon Cairns hadn't come in at that point in time, but you still thought that there was potential if they did the right thing. Had they done the right thing over the last 6 months? Are you feeling better towards Woolworths?
Look, I think Gordon's been there a bit longer than 6 months. But look, I think I've said all along, or we've said all along, that it's going to take time. It's a huge ship, you know, it's 40, 50 billion in sales. It's going to take a few years to turn around. And the reality is, you know, the competitive situation's not going to get any easier. You know, Aldi's not going to go away. Coles aren't going to let up. So Woolworths is at some point it may be okay, but I wouldn't jump in at the moment and fill my shoes full of them, because I don't think the signs are there that they've hit bottom yet and that there's a turning point anytime soon.
It seemed to me, I was looking at the stock from the point of view that if it went under 20, I'd be tempted to think, well, maybe this is starting to look like good value. Of course, the circumstance at that point in time would determine it. But it looks like there's a real resistance to get to 20. Like there's been a lot of market interested around $21 and it goes up to $22. It's a bit of a takeover target. Do you believe that is a takeover?
I don't believe it's a takeover target. No. Yeah, it's too big. And I believe the issues which are there, you know, and I don't believe Woolworths is that badly run that someone can come in and magically turn it around.
It looks good at the supermarket level, but the other aspects, like Big W has been a disappointment, Masters has been a shock.
And the real issue for Woolworths was that they were charging, you know, they were making an 8% margin on their supermarket sales. They've cut that margin now. They've had to, because they are, you know, completely out of whack with Coles and Aldi. They announced another 150 million recently in cost price cuts or whatever. So the reality is you're not going to see those 8% margins anytime soon. And, you know, they've got to try and live with 4 or 5% margins and still be competitive with Coles and Aldi, who are not going to sit there, you know, waiting for Woolworths to reawaken and take sales from them.
Okay, so this
it's not an easy situation.
So this is not a company
it's not terminal, but it's not easy.
This is not a company you're excited about. Is there a company at the moment you're excited about?
Look, in the last few months we've been buying a lot of Clydesdale Bank, which was spun off from
Charlie
NAB.
Aiken likes it too. He's probably been reading your notes, mate.
Look, Clydesdale's a reasonable investment, we think. You know, it was spun off from an unloved bank, spun off by a bank, you know, 15,000 miles away. So we think that will be quite a good investment the next 2 or 3 years. The results out next week. NAB itself looks quite interesting. I think NAB is, you know, the ship is stabilised. They've sold, or they're selling MLC this year, but they've sold all the underperforming assets, and now they're focusing on their core business. So NAB still looks reasonable. And then it's pretty itty bitty. You know, you've got to look around for things like perhaps Flight Centre, which has come down.
It's been clobbered a lot.
Yep, which again
seems like a good business to me.
It's not a bad business. Again, it's, you know, travel agencies and it is cyclical, etc. But it does have $1 billion in cash. It's got no debt. Once you take away the $1 billion in cash from the PE, you sort of come down to a PE of 11 or 12 times, which for a global business is a pretty reasonable price.
What about the overall market PE? Where is that sort of sitting?
Well, the industrials are now on about 19 times next year's earnings, you know, 2017, which is at the top end, you know, the high end. So, again, as a whole, the market doesn't look cheap. Again, it's difficult to say, you know, to say it's expensive when bonds are at record lows as well, and when rates are low. So, you know, for old timers like me and you, who've never seen
medium timers,
never seen.
Okay. But the thing is this: we grew up with the idea if the PE was 20, we would compare that to a 5% interest rate somewhere. We haven't got 5% interest rates.
That's right.
It's just so low. We could easily go to a PE of 25 and still look like in a good company. Not bad compared to the interest rates we can get.
Possibly, you know, but again, one's got to think about beyond the short-term nature of how low interest rates are, is what is your expectation for medium to longer term, bond rates? And 2% 10-year bonds in Australia seems
Unbelievable.
incredibly low, particularly given where the budget deficit is going.
One last question. If you have to make a pick about where you think the market will go over the rest of this year, are you of the feeling that even if there might be a sell-off along the way, that we will end up higher this year?
Look, again, Pete, exactly where. Look, I think around where it is, 200 or 300 points either way is sort of, I don't expect it to collapse because you've got lower interest rates. I don't expect it to take off because obviously there are still challenges.
Okay, so if it drops 200 or 300 points, buy that dip.
Specific stocks, yes.
Of course. Invest with Investors Mutual. Get you to do it for them.
Good idea.
Okay, that's Anton Taliaferro.